Welcome. If you're a business owner here in the UK, you already know that tax rules can feel like a bit of a minefield. And one of the biggest and potentially most expensive traps pops up right when you decide to deregister for VAT. What exactly happens to all your business assets? Well, in this explainer with some great guidance from the experts at ProTax Accountant, we're going to demystify that whole process for you. You know, it's something a lot of businesses think about, isn't it? Maybe your turnover has just dipped below that £88,000 threshold. Or hey, maybe you're just looking to simplify your admin and make your pricing a bit more competitive for customers who can't reclaim that. On the face of it, it sounds like a pretty simple way to cut down on paperwork. But hold on a second. Before you rush off to fill out those forms, you really need to know about a hidden trap that catches so many business owners completely by surprise. It's a rule all about the assets you still own, everything from your office computers to the company van, and it can lead to a really significant and totally unexpected tax bill on your final return. And that's exactly why we've partnered with ProTax Accountant. They're a UK firm that helps businesses navigate these kinds of complexities every single day. So together, we're going to break down everything you need to know about valuing your assets for that final VAT return so you can have a smooth exit with absolutely no costly surprises. Okay, let's dive right in. Here's our roadmap for today. We're going to start with the core principle, this thing called deemed supply. Then we'll look at which assets are affected, run through the valuation rules, highlight the biggest mistakes you can make, and finally show you how it all comes together on your last VAT return. All right, first things first. Let's get to grips with the fundamental concept that underpins this whole process. It's called deemed supply. And honestly, if you can understand this, you're already halfway to avoiding that hidden VAT trap we mentioned. So here's the core idea. When you deregister, HMRC doesn't just let you walk away with all the assets you've already claimed VAT back on. Nope. The deemed supply rule is all about balancing the books. Think about it. Since you got a tax benefit when you bought those items, this rule is how HMRC makes sure everything is squared away when you leave the VAT system. This quote really puts it perfectly. Just imagine your business on its very last day of being VAT registered holds a sale. The only customer is you, the owner, now operating as a non-VAT registered person. You buy all the remaining assets from your old business, and VAT has to be accounted for on that theoretical sale. Okay, so that covers the why. The next logical question is, who and what are we talking about here? Which businesses and which of your assets actually fall under this rule? Well, this rule applies whether you're choosing to deregister because your turnover is low or if you're required to because you've stopped trading. It covers all those tangible goods, the physical stuff, where you originally reclaimed the VAT. Now, what's really interesting here is the list of what's excluded. If you never claimed VAT on an item in the first place, maybe you bought it secondhand, then it's not on the hook. Same goes for intangible assets like goodwill and things that are zero-rated like most food stock. All right, so we know what's affected. The next big question is how much are we talking about? This section is all about the numbers, how to value your assets correctly, and the single most important threshold in this entire process. The process itself is pretty methodical. First, you've got to inventory everything. Second, and this is absolutely crucial, you don't use the price you paid. You have to figure out the current market value. The question to ask is, what would it cost me to buy this exact same item in its current condition today? That means you have to factor in all the wear and tear and whether it's basically obsolete. Only then do you calculate the 20% VAT on that total value. And this brings us to a key professional tip. You have to be able to justify your valuation if HMRC comes asking questions. Don't just pull a number out of thin air. Do a quick search on a site like eBay for similar secondhand items, save some screenshots, and keep them with your records. That evidence is your best defense to prove your valuation is fair and realistic. And here it is. The magic number, £1,000. This is the de minimis threshold that HMRC has set. If the total amount of VAT that you calculate on all your assets is £1,000 or less, you get a pass. You don't have to account for it, you don't have to pay a single penny. But, and this is a big but, you have to be incredibly careful here. This isn't an allowance, it's what's known as a cliff edge. As you can see, if your total VAT liability is exactly £1,000, you pay nothing. Great. But if it's just £1 over, at £1,001, you have to pay the entire amount. To put that into perspective, at a 20% VAT rate, assets with a combined market value of around £5,000 will put you right on that dangerous edge. Okay, now let's move into the area where the numbers can get very, very big.
very quickly. For most small businesses, we might be talking about a few £1,000s worth of equipment. But if your business owns property, the stakes get significantly higher. So where can this go most spectacularly wrong? What is the biggest, most expensive mistake a business can possibly make in this process? It's probably not what you're thinking. It's not about miscalculating the value of some old laptops. The answer is much, much bigger. That's right, your business premises. If your company owns its commercial property, the deemed supply rules can trigger a massive and often completely shocking tax bill that can easily run into tens or even hundreds of thousands of pounds. You see, there are two main traps here. First, there's the option to tax. If you opted to tax your property so you could reclaim that when you bought it, deregistering triggers a deemed supply based on its entire current market value. Second is the capital goods scheme. This applies to properties over $250,000. If you deregister within 10 years of buying it, HMRC can claw back a chunk of the VAT you originally reclaimed. Okay, so we've covered the principles, the assets, the valuations, and the biggest traps. Now for the practical final step. How does all of this actually get reported on your final VAT return? Well, your final return is kind of a hybrid. It's got your normal trading activity plus these special deregistration figures. So in box 1, you'll add the VAT from the deemed supply of your assets to the VAT on your final sales. In box 6, you put the net value of those sales plus the net market value of the assets. This is also your last chance to use box 4 to reclaim VAT on any final purchases and, importantly, to claim relief for any bad debts. And here's a crucial point that trips up a lot of businesses, especially if you use the cash accounting scheme. Normally, you only account for VAT when money actually moves. But for your final return, that rule goes out the window. You must switch to an accruals basis. That means accounting for all sales invoices you've issued and all purchase invoices you've received, whether they've been paid or not. It's a huge change to be aware of. So that was a pretty deep dive into a very technical area. Let's just pull back for a moment and recap the absolute key takeaways and what your next step should be if you're thinking about this. You know, when you put it all together, the main lesson here is that it all comes down to planning. This is not something you just decide to do one afternoon. You need to understand the deemed supply rule, be strategic about managing your asset values to stay under that £1,000 cliff edge, and be really aware of the huge financial risks if you own commercial property. Taking these steps lets you make an informed decision and avoid a nasty financial shock down the line. We've seen that this process has a lot of moving parts, from subjective valuations to cliff edge thresholds and some very complex property rules. Getting it wrong can be incredibly expensive. So what's the ultimate secret to getting it right? Well, before our final point, just a quick and very important disclaimer. This information is for general guidance. Tax legislation is really complex, it can change, so you should always seek professional advice that's tailored specifically to your business situation. And that disclaimer leads us directly to the answer. The single best way to ensure you are compliant, avoid all the traps, and have a truly smooth exit from the VAT system is to get expert help. The team at Pro Tax Accountants specializes in exactly this kind of work. They can give you clear, professional advice tailored to your unique circumstances. Give them a call on 07985689912 or email them at info@protaxaccountant.co.uk. And for more helpful explainers just like this one, make sure you subscribe to the channel. Thanks for watching.